5 costly mistakes that most people make when you start investing in real estate. And if you can avoid them, you'll reach your financial independence years earlier. Number 1, getting a small amortization on your mortgage. For example, getting 20-year mortgage instead of 30 years. Sure, you're paying the mortgage faster, but by making the monthly payments higher, you are ruining your cash flow today. And keep in mind also that today's money is worth way more than tomorrow's money. What I mean by that is that even with a regular 2% per year inflation, if you take $100,000 over 30 years, it will lose 60% of its purchasing power. Or to put it in simpler terms, your 100K today will be worth 40K in 30 years. I am sure that you've heard before your parents or grandparents telling you how cheaper life used to be. And if there's something I can guarantee you, is that the next 30 years your money will be worth less. I know it's unfortunate, but the dollar devaluation is part of our banking system, so we have to play within those rules. So with inflation, the cost of living is getting higher, but salaries don't follow. So when you understand those rules, even though you have a longer mortgage, you're keeping more money in your pocket now, and also the debt is tax deductible. So always get the longest mortgage you can possibly get to boost your cash flow today. Number 2, putting too much down payment to avoid the mortgage insurance fees. That's also a rookie mistake. Don't worry about the fees. If you can buy a property with 5% down, don't put 20% just to avoid the fees. I used to think like this too, and I was trying to save fees every time I could, thinking that it was a smart move, but I realized that it was small thinking, and it's exactly how banks want you to operate. But by putting 5% and paying the fees over 30 years, you are left with the other 15% to invest and buy another property. And because you understand positive cash flow rental properties, it will beat the mortgage insurance fees every time. You have to focus on the dollars, not the pennies. I was raised thinking that it was bad to have debt. And it's definitely right when you talk about credit card debt, consumer loan. Those are terrible debts. They are the roadblocks to your financial freedom. That's exactly how the system keeps you poor. 20% interest on credit card debt is so high that by the time you add inflation, it will be extremely hard for you to pay off. You want to be the one making 20% return on your money, not giving it away. But with real estate debt, that's the opposite. It's the leverage that accelerates your growth. It's because of that debt that you are able to make way above average return on your investment. Number 3, being too focused on the price tag instead of the income to price ratio. As long as you can afford it, the price of the investment does not really matter. What really matters is the income ratio that the property makes. If, for example, you can buy something for 100K or 200K, the 100K property makes 7K a year, that's a 7% gross income. And the 200K property makes 18K a year, that's a 9% gross income. So for you to become wealthy as fast as possible, you need to make sure that all your investments are bringing the best return possible. Even a couple of percentage point difference compounded over time will dramatically change your ROI. Number 4, not understanding the rentability of the neighborhood. One common pitfall for real estate investors is not fully understanding the rentability of the neighborhood they are investing in. While a property may look attractive on paper, the neighborhood can greatly impact its ability to generate rental income. It requires more than just looking at rental prices. You need to consider factors such as vacancy rate, tenant demographic, and the amenities and services such as public transit. Think like a tenant. Is there a grocery store nearby? Easy access to highways? And if you are in a city, the walkability and safety of the neighborhood. Is there parking on site or nearby? Understanding these will help you make more informed decisions about the type of properties that are most likely to generate steady rental income. It's important for you to do your due diligence and thoroughly research the neighborhoods you are considering before making any investment decision. You can always consult with local real estate agents and property management professionals who have expertise in the area. An easy general idea that I use is to look for places that have a Starbucks or a big bookstore nearby. Because if they open shop there, I know that they've already spent the money on researching the neighborhood and done the homework for me. Number 5, buying a place emotionally based on looks and not based on numbers. And trust me, we all do that when we are inexperienced. It's typical to see freshly painted units and nice countertop, and that triggers an emotion, especially if the previous property we visited was looking tired and dirty. That is a sales technique that sometimes real estate agents use. They show you 3 properties, one bad one decent one that fits your budget but is generally overpriced for what it is, and then the last one is beautiful and checks most of the boxes, but it's above your budget. This way, they'll try to trigger an emotional purchase from you. And that's totally okay if you're purchasing a home for yourself. But as an investment, you can get sidetracked by pretty florins and fancy kitchen cabinets. Think about it this way. You don't buy Apple or Tesla stocks because they're pretty. You do because they perform. An income property is no different. You need your investment to perform well. There is nothing wrong by buying something all renovated, but the problem is when you overpay for something because of the cosmetic upgrades that perhaps you could have done much cheaper. Don't overlook at a less renovated property because you didn't click with it emotionally or get that spark. With a small budget, you could do some minor changes like a fresh coat of paint or a new inexpensive backsplash, and you'll get that renovated look without a high price tag. As usual, if you have any questions, please leave them in the comments down below. Don't forget to subscribe and like this video. And for more tips, you can click in this video, and I'll see you over there.